The short answer, no, waiting usually doesn't pay off. While it's tempting to sit on the sidelines and hope for interest rates to drop back to 2021 levels, the reality of the 2026 housing market is that the cost of waiting almost always outweighs the potential savings of a slightly lower mortgage rate. In fact, for many buyers in today's market, waiting for a 1% drop in rates could end up costing them tens of thousands of dollars in lost equity and higher purchase prices. At Maya Team Inc., we see it every day. Buyers who were ready to pull the trigger last year but decided to wait and see. Now, in mid-2026, they are facing higher home prices and a more competitive landscape. If you are trying to time the market, you aren't just betting against the banks, you're betting against the law of supply and demand. As we move through May 2026, the mortgage environment has stabilized, but it isn't necessarily cheap by historical standards. We've seen rates hover in the low to mid 6% range for most of the year. While some analysts at the start of the year predicted we might see a dip into the high fives by this summer, the economy has remained resilient, keeping the Federal Reserve cautious. Here is what you need to know about the current trends. Modest declines. Most experts agree that if rates do drop, they will only fluctuate by 0.25% to 0.75%. The second half pivot. Some forecasts suggest that while we might see a small dip in mid-2026, rates could actually tick back up toward the end of the year as inflation data remains sticky. The new normal. The days of 3% interest rates are in the rear-view mirror. In 2026, a good rate is anything in the 5.5% to 6.25% range. When you work with a professional mortgage broker, they will tell you that the rate is only one piece of the puzzle. The real goal isn't finding the lowest rate in history, it's finding a monthly payment that fits your budget for a home that builds your wealth. Most people focus entirely on the interest rate column of their mortgage estimate. However, a real estate agent looks at the purchase price and equity growth columns. Here is why waiting for a lower rate often backfires. Real estate in high-demand areas continues to climb. Even if rates drop by 1% over the next 12 months, if the price of the home you want goes from $600,000 to $640,000 in that same time frame, you've lost. The math is simple. Scenario A, $600,000 home at a 6.5% rate. Scenario B, $640,000 home at a 5.5% rate. While your monthly payment in Scenario B might be slightly lower or even the same, you've missed out on $40,000 in equity. Furthermore, you are now borrowing a larger principal amount, which means you'll pay interest on a bigger number for the life of the loan. There is a massive amount of pent-up demand in the 2026 market. Thousands of buyers are currently waiting for a specific number to enter the market. The moment rates hit that psychological threshold, everyone will rush back in at once. What happens then? Bidding wars return. When competition increases, prices get driven up even further. No more seller concessions. Right now, in a slightly slower market, you might get a seller to pay for your closing costs or a 2-1 rate buy-down. Once the floodgates open, those perks disappear. Appraisal gaps. You may have to pay over the appraised value just to win the house, effectively losing money the moment you sign the papers. This is a classic industry saying for a reason. Your purchase price is permanent, your interest rate is not. If you buy a home today with Maya Team Inc., and rates drop significantly in 2027 or 2028, you can simply refinance. You get to keep the lower purchase price and the equity you've built, while eventually securing the lower rate anyway. You can't refinance a purchase price that was $50,000 too high, because you waited. Many first-time buyers feel stuck because they think a high rate means they can't afford a home. But the 2026 market offers several tools to make homeownership accessible right now, regardless of where the national average sits. FHA loans remain one of the best ways to get into a home with a low down payment. In 2026, FHA limits have increased in many California counties, allowing buyers to purchase more home with less cash out of pocket. FHA rates are also typically lower than conventional rates, making them a great hedge against the current market. If the main thing holding you back isn't the rate, but the cash to close, 2026 is a great year for DPA programs. Many programs offer 100% financing options or forgivable grants for those who qualify based on FICO scores and income limits. If you're still on the fence, ask yourself these 4 questions. Your answers will tell you more than any market forecast ever could. 1. How long do I plan to live in this home? If you plan to stay for 7 to 10 years, a 0.5% difference in your starting rate doesn't matter much. Over a decade, the appreciation of the home will dwarf the interest paid. If you only plan to stay for 2 years, you shouldn't be buying in this market anyway. 2. What is my rent versus by math. In many parts of California and the surrounding areas, rents are continuing to rise in 2026. Every month you wait for a lower rate, you are paying 100% interest to your landlord. That is money you will never see again. 3. Am I waiting for a rate drop or a price drop? If you are waiting for a price crash, you might be waiting a long time. Inventory remains historically low. Without a massive influx of new homes, prices are likely to stay firm or continue to rise slowly. 4. What is my FICO score? Sometimes the best way to get a lower rate isn't to wait for the market to change, but to change your own financial profile. A mortgage broker can show you how moving from a 660 to a 720 FICO score can save you more on your rate than any Federal Reserve meeting ever will. Navigating the 2026 market requires more than just an internet search. You need a team that understands the nuances of local inventory and modern lending products. At Maya Team Inc., we focus on educating our clients so they can make decisions based on facts, not fear. Whether you are looking for a standard conventional loan, an FHA option, or specialized products like DSCR loans for investors, the strategy remains the same. Secure the asset today, build equity tomorrow. If you've decided that waiting isn't the right move, here's your immediate action plan. That's 1. Get a real pre-approval. Not a pre-qualification from a website, but a fully underwritten pre-approval from a trusted mortgage broker. 2. Audit your budget. Focus on the monthly payment you are comfortable with, rather than the total loan amount. 3. Explore assistance. Ask about down payment assistance programs that can help preserve your savings for home improvements or an emergency fund. 4. Look for stale listings. Use your real estate agent to find homes that have been on the market for 30+ days. These are the sellers most likely to offer rate buydowns or price credits. 5. Stop timing the bottom. The bottom is only visible in the rearview mirror. By the time everyone realizes rates are at their lowest, the competition will already be too high. Does waiting for lower rates really matter in 2026? Only if you value a small monthly savings over long-term wealth creation. Real estate is a get-rich-slowly game. The sooner you get in, the sooner the clock starts ticking on your equity growth. Don't let the headline about high rates keep you from the stability and financial freedom of owning your own home. The market in 2026 is full of opportunities for those who are brave enough to look past the noise and focus on the numbers that actually matter. Ready to see what you qualify for today? Stop guessing and start planning. Whether you're a first-time buyer or looking to invest, our team at Maya Team Inc. is here to guide you through every step of the process. We'll help you run the math, compare the programs, and find a strategy that works for your unique situation. Contact Maya Team Inc. today.